Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global rate specialists, Giles Gale, head of European rate strategy, Blake Gwinn, head of front-end rate strategy in the Americas, and Theo Chapsalis, head of UK rate strategy. Hi everyone and welcome back to another Bondcast. It's been a second week really of rates yields selling off and curves steepening, certainly being led by the US. We've seen 10-year yields around 25 basis higher in 2021 and the 530s curve around 20 basis points steeper, two of which were big calls really in the year ahead for steeper curves and for higher rates. So Blake, I would say that's a job pretty well done, wouldn't you?
Yeah, Imogen, I'd love to, start popping the champagne and do a victory lap here. I mean, we had 10s for the year going up by about 55 basis points. We had 530 steeper by about 30 basis points, and we've essentially gotten half that move. But I think that'd be a little disingenuous of me, mostly because, we had really seen the first half of this year as being somewhat of a struggle, relatively range-bound trading, some difficulty seeing any kind of sustained rise in yields, a steepening in the curve. We really had most of that price action focused in the back half of the year after, vaccines proliferated and the economy started to return to some semblance of normal. So yes, we were correct on the direction, I think, but the way it kind of played out and how quickly it's played out has really been a surprise to us, compared to what we had expected back in November when we wrote that piece.
So what's happened there? Why has it moved so much faster than you expected?
Well, I think there's kind of two areas where we were really surprised or the things didn't really play out as expected. I mean, the first is obviously the Democrats taking Georgia. I think when we had been writing that piece, we had still expected that the most likely outcome was that the Republicans would win at least one of those seats and maintain hold of the Senate, that McConnell would still be the majority leader, and that he would use the power of that seat to basically slow down or kind of grind any Democratic agenda to a halt. And that includes stimulus, it includes any type of infrastructure spending later this year. So really kind of a dampening of any kind of fiscal expectations or any fiscal tailwinds for the next year. Of course, that didn't happen. Democrats won both the seats, surprising markets. They have control of the Senate, House, presidency now. And it's pretty clear to see the impact that this has had on markets so far. Given most of the sell-off we've seen, the most of that price action we mentioned up top has really come in the last week. It's really happened since those Georgia election results became known. To be honest, it's a little bit of a surprise to us because we'd actually been somewhat skeptical that, even if Democrats had won those Georgia seats, that this would really be, a huge game changer. They have control of the agenda. I mean, obviously being in charge of the Senate will give them the ability to bring things to the floor, to set the scheduling and get nominations done, a lot of other things. But, they still face a real uphill battle on the fiscal side, on the stimulus side, on infrastructure spending, those kind of items, any kind of big legislative priorities. They're still going to face a razor thin margin. They only have 50-50 with Vice President Harris serving as the tiebreaker. They face a potential Republican filibuster at every turn. They might have to get 60 votes. They have a couple opportunities to do things through this process called reconciliation that would allow them to do a simple majority. They probably have two chances to do something like that. So they have to pick which priorities to use those on. But that's also a difficult process and has a lot of potential pitfalls. So not only were we kind of surprised that the Democrats won both of those seats, but we were also a little bit surprised in how positively markets have reacted to it, given that we're still a little bit pessimistic on how much stimulus and how much fiscal tailwind is really going to come out of that. The second surprise, and this is perhaps a bit less discreet, it wasn't like it happened and then we saw this big price move like we did with the elections. But I think it's still been in the background, kind of allowing yields to rise, curves to steepen a little bit more than we had originally thought back in November. And that's that the Fed's essentially been kind of throwing buckets of cold water on this idea that they were going to do an adjustment to their maturity structure for their treasury purchases. When we wrote the year ahead, I think there was a pretty prevalent view in the markets that the Fed was going to come in December and start buying more longer term securities, which would have pushed down long-term yields and helped to flatten the curve. We didn't necessarily expect that, but we did think that they would be kind of in this position that they would react to any undesired or unwanted rise in yields. And that having that threat of them coming in and pushing back against a quote unquote bad yield increase would have really kept markets in line and would have kind of nipped any sell-off or any kind of steepening into the first half of the year in the bud, because markets would have just said, hey, if yields start rising, Fed's going to come in here and start buying longer term assets. On that front, we weren't necessarily wrong. In the the rise we've seen so far this year is not what I would consider a quote unquote bad rise in yields. It's come along with increases in inflation expectations. It's come along with that optimism on the fiscal side. So it's not something that's driven by oversupply of treasuries or expectations of a premature hike or anything like that. So it's not that the yield rise we've seen is something that we think would have prompted the Fed to act. But I think what we have seen is that when the Fed didn't change their asset purchases in December, when they came out in the minutes, when Powell spoke, and even a slate of recent Fed speakers, what we've seen is them really kind of expressing this comfort with where yield levels have gone. They've shown essentially no urgency in kind of delivering this maturity extension, and as a result, markets have basically started to kind of take that expectation off the table. So, when you remove that threat of them coming in to do this maturity extension, I think that's really allowed this yield rise to happen and curves to steepen without the market immediately starting to think, okay, the Fed's going to come in at the next meeting and push back against this. So both of those things are, I think, really where I would say we've been wrong or we're wrong in that November year ahead, and where there's really been a surprise to us with how fast yields have actually increased to start this year.
Okay, so you say we've been taken a little bit by surprise by how fast they've moved, even if we were right about the general direction of travel. So where do you think we go from here? Does this kind of fast-paced sell-off continue? Is there a particular event that we're looking to that might be a turning point? Do we see it slowing down? What are you thinking?
Yeah, I mean, we're actually in a pretty crucial week here. Just from a technical perspective, we're kind of at the top of this very long-running channel. It's this kind of trend that's been in place since August, and we're very close to kind of breaking above those yields. And if we go through there, pretty decisively, it's hard to see kind of where markets would really find comfort that there would be some kind of support for the Treasury market. So it could continue to fall for quite a bit longer if we break through these levels that we're currently at. On the other side, though, I think we kind of lean a little bit, that's a technical perspective. We lean a little bit more fundamentally in saying that if you look at the next month or so for us, we think this sell-off is probably a little overdone, and we probably pull back, retrace some of the sell-off that we've gotten to start this year. I don't think we go back to kind of those late 2019 levels, but I do think we probably end up settling into a range that's a little bit lower from where we're currently at, if not back to those 2019 levels. The fundamental things we're looking at, as I already mentioned before, we're a little bit pessimistic on the fiscal side. I think the optimism's really kind of run away with itself after this Georgia election, and that as we get to the real nitty gritty of negotiating another fiscal package and we see those battle lines being drawn and the negotiations start dragging out weeks or even months, we think there's going to be a little disappointment there. Also, don't forget that the COVID situation is still accelerating, getting a lot worse here. And, the possibility of some type of, I don't want to say national lockdowns in the US. We don't really have the president doesn't really have the authority to do the same type of national lockdowns here that we've seen in other countries. But there are a lot of ways that a Biden administration could theoretically curb activities, in the US and really kind of move to make to kind of slow down economic activity. So that's a risk that we don't think's really been priced into markets yet, and something that over the next weeks, or even months, if we see those case counts accelerating, that's something that could start to play out. So fundamentally, we're leaning we're leaning towards some kind of retracement, a little bit of a rally from here. But as I said, the next week's going to be pretty telling, where we kind of end up on that technical piece.
Okay, that makes sense. So switching gears a little bit and thinking about Europe then, Giles, where unfortunately we are all back in national lockdowns. European rates have so far been relatively resilient to this big move that we've seen in US Treasuries. Do you think that's right?
Well, on a certain level, yes, it is, clearly. I mean, something's changed in the US, which is that, markets are just updating and trying to find a level. given the news about the change in the political situation and the possible impact that that might have on the fiscal side. Now, in Europe, obviously, we haven't had that. I mean, we've talked a lot about fiscal policy on these before, and obviously we think it's super important, but the background is in Europe that that's just kind of ongoing. There's no real new news in a way there. Where I don't think it's right is that I think to the extent that inflation expectations, perhaps relatively far in the future, are pushing rates higher in the US, I'm not quite sure what it is that people think is that dramatically different about Europe. I mean, from my perspective, you should be talking about European inflation rising for pretty much all the same reasons, whether those are short-term reasons, things like this upswing in the commodity complex that we are seeing and has been ongoing for a couple of months now, a few months, I should say, or whether it's just based on sort of longer-term factors. That's something that we think is key and in the background and also changing as well, or whether you just think it's to do with economic recovery. So we've seen that a little bit start to move in European break-even inflation. So inflation expectations in that little corner of the market have been picking up, with a fair lag to what we've seen in the US, but nonetheless, I'd say that there are some signs of life there, but nominal markets really seem very much under the thumb, I suppose, enthralled to the ECB and just this pessimism that the ECB is just has this market kind of by the scruff of the neck. I mean, a little bit shorter term, we've had a lot of evidence of cash on the sidelines, perhaps not put to work in the last part of last year, that's been coming out to meet the supply that we have seen the usual glut of at the start of the year. And so, I suppose that's maybe, the background consideration just for the short term. It seems like the foundation for demand is pretty strong in any case.
Okay, so our big call in the year ahead in European rates was that we were very bearish core rates. So now, mid-January, we've seen a big sell-off in treasuries and not quite so much in bonds. Are we still bearish? Do we still think that higher in yield is the direction of travel for European rates?
Yes, absolutely. And listen, I think that something that I should try to remember, I'll make a mental note to always repeat it, and until such time, of course, as it changes. European rates are really priced for disaster still. And I don't think that that's what's going to be the dominant theme of this year. And of course, we're in week 2, and we have lots and lots of sort of fairly pessimistic sounding COVID headlines still coming through. But I think that overall this is going to be a year of recovery, and I think that the market can actually ship quite a lot of bad news on the COVID side in the short term. I think it's already incorporated quite a lot, and I think that one of the things we've talked quite a bit about is the resilience to it, that's sort of built into all Western economies, to be honest with you, including the euro area. And every time we're allowed out again, it seems like the economy bounces back a little bit more strongly than people had perhaps expected. And I think that as things progress and we're entering, sort of warmer weather and vaccination programs are progressing, even if a little bit, behind where we would have liked them to have been, I think that we will see optimism starting to return. So yeah, I think that is an important part. But I just want to make one final point on this, is that I think there's a cross-border dimension as well. And I think that we should have sold off more, perhaps in sympathy with the US. US fixed income looks really attractive to European investors and international investors alike. I think that there's a risk that US corporations actually start funding in European markets, and just swapping that cash back, and that could add a little bit to the supply pressure as well. So I think that there are a lot of things all pushing in the same sort of direction that can really come to the fore in this year.
Okay, perfect. Well, you've saved me a job because you answered what was going to be my last question about US versus Europe view that we put in the year ahead. So thank you for that. So with that, I guess we can move on to the UK. Theo, have seen gilts sell off in recent sessions, I guess, in sympathy with the move that we've seen in the US. Does this provide better entry points, you think, for now being long gilts, or would you still prefer to wait here?
Yeah, I think this is a key question. So first of all, gilts in the UK market is the only market where we have been long in the 2021 year ahead, and that is a high conviction call. It's a strong call to be long the back end of the curve, 30-year conventional and real rates. When we take a look at the last 2 months, basically what we see is yields that have substantially outperformed peers in December. So gilts have done really, really well, and they've given up some of the gains in January, right? So the move in the US clearly did impact the UK, and gilt yields followed more than bonds. Now, to your question, the sell-off, is this an opportunity? We think that we're very close to that, very close to setting up a structural long opportunity in the UK market. On the 13th of January, it's basically coupon money that is being paid and does provide some support. And actually on the 22nd of January, we've got around 3 billion of gilts. So it is this coupon money being paid. So we talk about significant money that does support the market. But at the same time, we've got also a syndication on most likely on the 19th of January. So this additional supply, I think, will provide an opportune moment to go long. As things stand, the momentum is probably for gilt yields still to cheapen simply because of the cross-market argument. And this is something that Giles mentioned, and he looks at US fixed income and compares that to European fixed income. And well, I compare that also to the UK. We've got Brexit, but we still consider ourselves European. So what we see is that gilt yields also relative to US yields seem to be low at this stage. So I would expect basically the tactical guys to be selling the UK curve still, but I think that this indication will provide an opportune moment. And the reason is really because the UK market will be structurally in a more challenging situation. We have seen that the UK has become the fifth greatest country, or the fifth country with most cases of COVID. So I don't know whether we can use the word great in that case. Probably it's wrong, I would say. So, but it's the fifth country in terms of COVID cases. So this is significant, which means that basically the potential for lockdown is fairly severe, which means a disruption to the economy, which means that there are structural reasons to be long gilts. We need to add to that the QE, the ongoing QE, which is very much supportive for the back end of the curve, and at the same time, demand from LDI investors. So if you take all those points, then we've got a very supportive case for gilts, but probably this is something that we should do later in the next weeks. And I think one point that I wanted to mention, Imogen, because we've discussed about the US, we've discussed about everything, but it's inflation, right? So inflation is something that probably it's worth bringing up. And I think what I find particularly interesting is what is going on in global markets, and especially the US, and especially the front end of the curve. So this is also a part where we think that it is a sector that has been cheap for years, and it is the part of the curve that really moved the most relative to everything else. So this is, I think, quite a big theme, that it's not just inflation expectations, it's also at the same time support at the front end of the US inflation curve.
Okay, great. Thanks, Theo. I think that's a good place to wrap this up for this week. It's been another very, interesting week, I would say, in rates markets, and felt like a good time to kind of mark to market our year ahead views. I hope that, not that we will do this at the end of the year, but I hope that if we do, then we can be just as right then as well. Thanks, everyone. Speak next week. I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.